Welcome to This Explainer. Okay, today we are going to challenge literally everything you thought you knew about traditional accounting. Seriously, if you think accounting is just about, monotonous bookkeeping, balancing dusty ledgers, and just crunching historical profit and loss numbers, well, you're in for a pretty big surprise. Today, we're looking at how this entire profession has undergone an absolute transformation. Drawing on some really excellent course materials provided by IGNU, we're going to explore how the very definition of a company's value has rapidly evolved. As you'll see, modern accountants aren't just number crunchers anymore. They are required to be highly intelligent, strategic visionaries. They are tracking way more than just money moving in and out of a bank account. To really get the whole picture, we'll be journeying through 5 distinct paradigms. First, the limits of conventional accounting, then people, planet, and society. After that, we'll hit global markets and inflation, strategic costing and ABC, and finally wrap up with the IT accounting revolution. Okay, let's jump right into part 1, limits of conventional accounting, and why it became the catalyst for change. Let's start by totally dismantling the illusion that conventional financial reports tell the whole truth. Because honestly, they don't. Historically, we've relied on the usual suspects, right? The profit and loss account, the balance sheet, the cash flow statement. But do these actually capture a company's current strength, or more importantly, its future potential? Think about long-term assets for a second. Imagine a company bought 10 acres of land in Mumbai or Delhi 40 years ago for, let's just say, 10,000 rupees an acre. Traditional accounting says, hey, record that at its historical cost. But does reporting that ancient historical price on a balance sheet today reflect its actual value? No way, not even close. That land is literally worth hundreds of times more now. And that example right there just perfectly illustrates the glaring blind spots of traditional accounting. It relies way too heavily on historical value. On top of that, it completely fails to capture the worth of brilliant employees. It actually just treats them as an expense. It has the super narrow focus on maximizing profit while totally ignoring its environmental impact. Plus, it usually uses outdated product costing systems and relies on these standalone IT silos that aren't even talking to the rest of the business. Moving on to part 2, people, planet, and society, valuing the intangible. So, to fix these massive blind spots, modern accountants have actually developed specialized branches to value the intangible assets of a business. This builds a much more accurate picture of a modern corporation, especially the knowledge-based ones. Take a look at this staggering number on the screen, 9,539.15 crore rupees. What asset do you think that is? I'll give you a hint. It's not factories, it's not machinery, and it's definitely not real estate. This is the exact value of the human resources that Infosys reported on its balance sheet back on March 31st, 2002. For software and IT firms, human capital is the ultimate asset. But the big question is, how do you even quantify a human being's value to a company? Well, Infosys calculated this massive asset using a framework called the Lev and Schwartz model. Basically, it involves evaluating all direct and indirect compensation, calculating incremental earnings based on the employee's age and group, and then discounting those future earnings using the company's cost of capital. So the takeaway here is absolutely crucial. Human capital can and really must be quantified if you want a complete financial picture. When a company can actually assess an individual's worth, it inherently increases its own worth. But modern accounting doesn't stop at employees. It also measures a company's relationship with the wider world through something called social accounting. This uses highly specific, auditable indicators, things like health and safety, employment equity, and human rights. Think of it like a social balance sheet. And it is not just some fluffy PR exercise. It's a real strategic intervention. By putting it all out there, full disclosure of both the good and the bad, a company is basically forced to actually perform better. This improves their reputational risk management and ultimately gives them a competitive edge. Closely linked to all of this is environmental accounting. The fundamental premise here is what we call internalizing external environmental costs. See, normally society just bears the cost of a company's pollution because we treat the environment as a public good. But environmental accounting changes the game. It forces organizations to trace the actual costs of their activities on the ecosystem, forecast potential ecological impacts, and actually create financial provisions for environmental risk. It bakes sustainable development directly into the day-to-day business operations. All right, let's hit part 3, global markets and inflation, macro accounting. Now let's step back for a second and look at the macro environment. How do huge global challenges alter a company's perceived profitability? Well, first up is inflation.
During periods of high inflation, sticking to a traditional historical cost approach can be downright dangerous. It drastically understates the value of inventory and the plant used in production. Inflation accounting steps in to correct this by using current cost methods. This prevents the hidden erosion of capital. It ensures that a company actually has the funds available to replace its assets when the time comes, instead of waking up one day and realizing their historical depreciation savings won't even buy half a new machine. Meanwhile, we have international accounting. This tackles the complex, honestly sometimes nightmarish, reality of trade liberalization and overseas expansion. Just imagine trying to consolidate financial statements when your operations span half a dozen different countries, all with wildly fluctuating currencies. Plus, investors in different regions want statements in their own specific standards. An Indian company like Infosys, with investors all over the globe, might have to present statements in Indian GAAP and US GAAP just to keep everyone happy. Handling those multi-currency operations and varying international standards, that is a monumental task for the modern accountant.
Section 4. Strategic Costing and ABC, the operational edge. So moving from that big global macro level down into the operational weeds, how do companies strategically manage their costs in a fiercely competitive market? A major tool here is value chain analysis. Let's say you manufacture PET bottles for mineral water companies. You've got a strategic choice to make. You could build one massive, centralized plant to get great economies of scale, right? But that forces your customers to hold massive amounts of inventory. Or you could decentralize, build smaller plants right next door to your customers. Sure, it might cost you a bit more to manufacture, but it saves your customers a ton of money on inventory space. Strategic cost management is all about looking at that entire value chain, not just staring at your own isolated production costs. To make those big strategic decisions, you need rock-solid data. And this brilliantly illustrates why activity-based costing, or ABC, is so vital right now. Traditional costing often just kind of lumps overhead together and allocates it randomly based on a single unit, like direct labor hours. But ABC gets it. It recognizes that a firm is really just a bunch of interconnected activities. It traces overhead costs directly to the specific activities required to produce a product or service. This completely prevents that dangerous misallocation of costs you see in traditional systems, and it gives decision-makers a crystal clear, cross-functional view of where the money is actually going. And finally, Section 5, the IT accounting revolution, integrating the enterprise. So, with all this modern complexity, valuing human resources, tracking environmental impacts, juggling international currencies, tracing activities, how is any of this actually manageable? The truth is, it wouldn't be possible without the engine of information technology. Modern IT doesn't just digitize old paper ledgers, it integrates the entire enterprise. Consider an ERP, Enterprise Resource Planning Chain Reaction. Let's say inventory drops below a certain threshold. Boom. Instantly, the ERP system auto-generates a purchase order and fires it off to a vendor. The material arrives, and the receipt is electronically matched against the invoice. If they match, the payment is fully automated. A process that used to require dozens of manual, mind-numbing data entry points is now just this invisible automated flow running off a single company-wide database. It's a real game changer. Which leads us to one final provocative thought. If ERP systems and computers are now handling all the basic automated arithmetic and data entry, what happens to the accountant? While far from being replaced, today's accountant is totally liberated. They're empowered to navigate global strategy, to drive environmental sustainability, to champion the true monetary value of human capital, and to manage complex strategic costing. The accountant is no longer just a simple bookkeeper. They are the strategic visionary steering the entire modern enterprise. I want you to really think about that the next time you look at a balance sheet. Thanks so much for joining me on this explainer, and keep questioning what's beyond the numbers.